You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone. Welcome back to the Infinite Banking Mastery Podcast. Pension Max. That's what I want to share with you today. How to maximize your pension and using the infinite banking concept, which would just make it a little bit better. So, of course, not all of you have a pension. I do know that pensions are a dying breed and not a lot of people are getting jobs at where they have pensions or are starting pensions. But I do happen to know quite a few people, from even in my own family, who do have pensions and other clients and friends who still have them. So I thought this would be a good idea to have an episode on this topic just because I think it will be helpful to a lot of people I know. And if this information is not super helpful for you, feel free to send this information along to someone you know who it could help. If you know of someone who has a pension, I hope that this information could help some of your loved ones. Let me start off by saying pensions are awesome. So if you have one, I am happy for you. They are great. You are able to have a lifetime income for both you and your spouse that you cannot outlive. It will pay you for the rest of your life. Both you and your spouse's life, that is. There are different types of pension payouts, and this can get confusing, and it's probably going to be a little hard to describe over a podcast, but I'm going to just throw out some numbers to try to help you have some more understanding with how it all works. So let's just say that you have a pension, and if you decide to take income for your life only, meaning that when you pass away, your spouse gets nothing. That's the highest payout because they're only promising to pay through one life. Let's just say that amount is $5,000 a month. So you're able to receive $5,000 a month while you're alive, and then when you pass away, your spouse gets nothing. Or there's a second option where you could receive $4,300 a month for the rest of your life, but then when you pass away, your spouse would get $3,200 a month for the rest of his or her life so that you have more to enjoy while you're alive. Then they might give an option like, well, you each can have $3,700 so that your spouse's monthly amount will be higher than the $3,200, but then yours is even lower. So there's only really one scenario where it makes sense for you to choose one of these spousal options. For most people, I would say. Sometimes, there's all different kinds of circumstances. So sometimes a spousal option might make sense for a couple. But really, when you're looking at the general population, for most people, I would say there's really only one scenario where it makes sense to choose a spousal option. And that's if the person retires or you retire and then right away you pass away. Oh no. Terrible. But then you would have taken, say you took option 2, you took the $4,300, you pass away, your spouse gets $3,200 the rest of their life. However, if you live a really long time, then you would have taken a lower amount and you both would have been living off that lower amount for a long time. Or let's say your spouse passes away first. Now you've taken a lower amount that you're locked into, even though your spouse passed away and now that person's not going to receive a benefit anyway when you pass away, and now you're locked into a lower amount. Or let's say, unfortunately, you'd have a car accident. Something terrible happens. You're out to dinner, you crash, you had a car accident, and now both of you pass away too young. Well, in that scenario, then there is no more money to go to anybody else. In most scenarios, the pension company just keeps the difference. I mean, some pension companies may have a death benefit for so many years or a death benefit regardless or no death benefit at all. But in just most cases, when both spouses pass, there is no death benefit. If there's money left over that technically they should have been able to be paid out, nobody receives it. It's just left with the pension company. So I'll say it again. The only scenario where it makes sense when we're talking about the timing of your passing as the pension holder is if you go first and young, like soon after you start receiving your pension. And in combination with this, your surviving spouse lives a long time. Otherwise, under the other three scenarios, it would be better to have a life insurance policy in place. So you could start a life insurance policy, and a lot of people want to wait until it's time to take the pension. It's until they're thinking about it, until they're close to retirement. Now they're thinking, what are my options? What could I do? And then, sometimes we get an opportunity to teach this to people. But actually, you should start looking into it before you retire. And the younger you are, the better it is because you have more time. So, an alternative to just simply choosing a spousal, because of course, or a spousal option, because of course you would like your spouse to receive an income. You don't want them to be broke after you pass away and have no income. So, we want to still have an income for the spouse, but you could replace that income that the spousal would have paid from the pension by using life insurance, having a large enough death benefit so that if you pass too young and the spouse is still alive and now needs a monthly income stream, that death benefit would create that monthly income stream. Once you pass, there's a death benefit. Now that person can put that money into something else, like build their own personal pension, where they now have an account that's going to pay them the rest of their life that they cannot outlive, or start another infinite banking style policy if they're insurable and that's something they want to do, or maybe a combination of these ideas. Once the surviving spouse receives the death claim, the death benefit, there are numerous things you can then do with the money. Ideally, of course, you do want to create an income stream out of it. So when you're building that plan, or when I'm building that plan for a client, I'm usually looking towards, let's make sure that when the death benefit pays, we would be able to replace the income that your surviving spouse would have received. And again, starting early really is the key, because it leaves you with so many more options. And a lot of times when people are starting younger, they may not have a lot of income to put into life insurance, or they don't want to put a lot of money because they don't understand infinite banking and all the coolness. Even just getting a term insurance contract and locking in that insurability so that when you arrive to your retirement and now you're thinking, oh, now what do I want to do? What can I do? You already have the insurance and the insurability locked in. And so then you have the option to convert that insurance from term into a whole life contract. So now it's a permanent contract so that you can use it for this strategy. If you wait altogether until you're ready to make a decision, now you may not be insurable. So you don't want to wait till the last minute and start thinking, what do I do now? I mean, it's certainly lots of people do it, and it's still something we can work out and figure out. But it's going to be in your best interest. It's going to work better for you if you start planning earlier, start planning ahead of time, and start looking at what you can do, whether you need to just lock in some term for now and then you will convert later at retirement, or whether you want to start building your savings plan now, your whole life now. That way, when you reach retirement, you will have already built a savings inside of your whole life policy that can also be used while you're retired, and also there to protect for when you pass away. Now your spouse has a death benefit to create an income stream from. And so you have a lot more ability to build money, you have a lot more options to be more prepared when you hit those retirement years. A lot of times, whether you're converting term or whether you are just starting a life insurance plan at the time you're retiring and making your selections for your pension and everything, a lot of times clients are using that gap in the difference of the spousal option versus the single life only option. That is oftentimes where they're getting that money to be able to buy the life insurance, especially if you wait that long, because the life insurance is more expensive. So, for example, using the numbers that I used earlier with the $5,000 single life only, pays only through one life, versus taking a reduction down to $4,300, leaving a spousal benefit of $3,200 when the pension owner passes away. So you can see that that person would already have to make a selection to lose $700 right off the top. They're either going to receive $5,000 for their life only, or they're going to protect their spouse and lose $700 a month right off the top. A lot of times, people will use that $700 to buy the life insurance. So you're going to be out the 700 either way if you're protecting your spouse. You're either going to choose the spousal and be out the 700, or even more if you choose to have the spouse have more money when you pass away. You want him or her to have a higher monthly amount once you pass, then you're both going to have a lower amount, even lower than my $4,300 example in this scenario. But in the scenario where the surviving spouse or the spouse would lose $700 right off the top just from choosing to protect their spouse, those are the funds that oftentimes are being used to buy the life insurance. So again, if you start this sooner, then the policy may not cost $700 a month or $800 or $1,000. Sometimes the insurance is more to be able to buy a large enough death benefit to protect the spouse so that if you pass too soon, that person can get a large enough income stream that would basically be the same as, or maybe better than what they would have received had you selected the spousal option. So it's better to start sooner. Life insurance only gets more expensive as you age. So the younger you can lock it in, the less it will be, the healthier you're likely to be. So health, again, is another factor that helps the price be lower. So starting younger, starting healthier is going to lock in a lower price for you. And then you're able to start a whole life policy that will start building cash that you can use. And you have more time to get that cash to be growing and to be something useful. And a lot of times people will do a combination of whole life and term just to have that death benefit high enough to be able to start saving now and to be able to convert that term later if they need to boost that death benefit up at the time of retirement to cover that spousal option where they would have received that monthly amount. You need a large enough death benefit to spin off that spousal option. So in my example of one spouse receiving, the pension owner receiving $4,300 a month, and then that person passes and the spouse receives $3,200 a month, we're needing to create a large enough death benefit to be able to spin off at least $3,200 a month when the pension owner passes. And so that's really what we're looking to do when we are factoring in life insurance for this. Sometimes there's out there, people will say, oh, well, you can just cash out your whole pension and get it something else, an annuity, or invest in something. And so there's other ways people are saying you can maximize your pension by doing things like that. Although I would be careful because a lot of times it's hard to beat the pension that you're already going to be receiving from your workplace. So cashing it out and taking the lump sum and then trying to create your own income stream might not be the best. I know that sometimes people will say, oh, it's good because now you have the lump sum. If something happens to both of you, at least there's a lump sum that will go to your children or to whoever your beneficiary is. Because again, when both of you pass and you have a pension, the money is kept with the company. So there's all sorts of things to look at and think about when you're considering this. Oftentimes, I do like better keeping the pension rather than cashing it out. It's per person, per scenario. Really, it needs to be looked at for each person. But I do like the idea of replacing the spousal option with life insurance if it's feasible, if the person receiving the pension is insurable, and especially if they have time to build up some cash. Now, if we look back to the things that could happen, the different ways that the one spouse or the other will go first, you can see that having a life insurance policy in place works out better most of the time. Because if you have a life insurance policy built and you both live a long time, then it will be great because there will have been cash built up inside. You will have been able to use it. And then when you both pass, you'll have a nice legacy to leave to your children or charity or whoever you want to leave that money to. You will have built up a nice amount of cash in there. Also, you will have had protection for a long-term care need, a critical care need, a terminal illness. If the spouse was to go first, now you have this life insurance policy. Maybe it is costing a lot because you waited until you were older. Maybe it's expensive per month. Now you can maybe reduce your payment. Maybe you want to leave a death benefit to your children or loved ones, but you don't need such a high premium because it's making your budget tight. You might drop the premium and continue funding the policy or even discontinue funding the policy. If maybe you want to discontinue it altogether, and then you have a big, huge lump sum of cash that you get to keep. Of course, if it is more than the amount you've paid in, if the amount of the cash value is higher than your cost basis, then it will be taxable, the earnings. But either way, you'd have this lump of sum of cash that you could do something with, and you would no longer have a premium, or you would have a lower premium if you reduced it, and you would still have your higher pension payout had you selected single life only. Or if you both passed too soon after retirement happened, then you barely paid into this contract and it leaves a big fat death benefit for someone you care about. Again, in all three of those scenarios, it would have been better if you are just trying to choose between single life only and the higher payout option, or should I select a spousal option? In any of those three scenarios, it would have been better for you to have the higher option because you both would either live longer together and have the higher option for more years, or your spouse goes first and you would be able to retain the higher option because your spouse passed and you're not locked into that lower option. Or you both go too soon, but still you had the higher option while you were both alive to enjoy that money instead of having that lower option and having to cut expenses and cut fun things you like to do. Better to have as much as you can to enjoy, or some of that money might be going to premium if you're starting a policy later in life or when you're ready to retire. But still, it's building cash that you can use. It's not just going away. So you actually will have use of that money, not just have it going away altogether. Whereas if you select a spousal option and lose $700 off the top, that $700 is not going anywhere for you to use. It's not building for you. It's not anything. It's just disappearing. And then if you both pass too soon, no death benefit, no nothing. I just want to mention too that sometimes when a person is making this decision, there's not a lot of room to build a policy in an IBC fashion. Because remember, when we're building those types of policies, we're shrinking the death benefit in order to make your cash value more efficient. And with the pension max situation, we often want a pretty large death benefit that will be able to replace an income later on. So it may work out that you end up having a more traditional style whole life contract. It really just depends on what is going to work for the situation. But again, the younger you start, the more we're able to structure the policy as a cash efficient vehicle instead of having the primary goal of the policy be for the life insurance. Either way, it will build cash. It will just build more efficiently as an infinite banking style policy. So that's all I have for you on pension maximization. I do hope the information was interesting, helpful, that's helpful for you, or you know of someone it can help, and that you pass it along. If you have any questions on that for yourself, or if you're planning this for yourself, or you have questions just on infinite banking as a whole and how you could work that out and create policies for you and your family, and if you would like my help, I would love for you to reach out. You can reach me at Valerie@alphaomegawealth.com. I look forward to speaking with you. I hope you reach out and I hope you have a great week. Take care.
This is thepodcastfactory.com.